I don't
standpoint.
think the presidential election addresses the problems. Neither one of the parties, and in many respects, they're proposing programs that will make situation worse than better. You raise the tariffs in any significant way, you force retaliation. It's an ill-advised policy. It's as ill-advised as instituting wage and price controls. I mean, it's so contradictory to fundamental economics to do either one of them. But it's an indication of where these two parties are now. Both are proposing increases in the national debt, and that will send us further down the law of diminishing returns. And it's really not clear to me who has the plan to increase the debt the most, but both of them have big plans, expensive plans, and no effective way to pay for them.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Now that it seems the Fed has officially pivoted, what will lower interest rates mean for the economy and financial markets? Will they be enough to keep recession at bay and prevent a further rise in unemployment? Where will the trillions of investor capital currently parked in T-bills and money market funds go if the yields on those assets start going down? For a true expert's view on these important questions, we've got the great fortune to sit down today with one of the greatest living economists, Dr. Lacy Hunt, former senior economist to the Federal Reserve Bank of Dallas, as well as several of the world's largest global banks. He now serves as Executive Vice President and Chief Economist of Hoisington Investment Management Company. Lacy, thanks so much for joining us today.
Great to be with you, Adam. It really is.
Oh, it's always a pleasure, Lacy. Thank you for making the time to come on. We got a lot of important questions to discuss here. Real quickly, before we dive into it, I just want to thank you again for being willing to give the keynote presentation at the Thoughtful Money Fall Online Conference, which is coming up on Saturday, October 19th. I hear every year, usually you kick the conference off with your unbelievable slides and your walk through the data. It truly is a graduate level course in economics. And usually that takes up the first hour or a little more of the conference. And invariably, when you wrap up, I get a ton of questions in the live or a ton of comments in the live chat that say that was worth the price of admission right there alone. So, anyways, very excited to have you back this year.
I'm glad to be it, and I'll tell you what, I'm looking forward to it as well, because the questions that I get from your audience are fantastic, and they force me to think about issues that sometimes I hadn't thought about, and they're a very perceptive audience, and it will be a learning experience for me as well.
Well, thank you, and I agree. There's a lot of smart people in the viewers here, a lot of curious-minded, critically thinking people, but a lot of Lacy Hunt fans among that crew. So, folks, if you're interested in learning more about the conference, perhaps signing up for it, go to thoughtfulmoney.com/conference. All right, Lacy, on to the many questions I have for you here. Let's start with the one I always like to kick these discussions off with. What's your current assessment of the global economy and financial markets?
Well, I think that the outlook is very poor, both domestically and globally. In the United States, the fundamental problem is that monetary and fiscal policy are way off course. With regard to fiscal policy, we now have had 5 consecutive quarters of negative net national saving. This is a very, very profound development. It means that the Keynesian concept of the paradox of thrift disappears. One of the key arguments of the Keynesian approach was that in economic downturns you have too much saving, and therefore the government should step in with deficits in order to utilize this saving and to give the economy a kick. However, we don't have saving anymore. The paradox of thrift doesn't apply. We have the negative net national saving is about $150 billion. And very round numbers, we have a federal saving of 2 trillion and only about 1.85 billion of private and foreign saving. And we know from the circular flow, both conceptually and algebraically, that gross domestic income must equal gross domestic product. And one of the consequences of that, same thing algebraically, is that physical investment must equal net saving. And right now we have negative net national saving. And this is only the third time since 1929. We had 4 years during the Great Depression, and we had 3 years of negative net national saving in the Great Financial Crisis. But what is different and unusual and totally inappropriate, based on historical experience, is that we have negative net national saving and the economy is still growing. And as the downturn deepens, which I expect, the receipts will fall off, transfer payments will step up, the negative net national saving will increase. There are proposals to further increase federal debt. And we're going to have a more fundamental problem. And at the same time, the Federal Reserve is behind the curve. I like to look at detrended M2 and other deposit liabilities even more closely. If you look at that, historically since the 1950s, real M2 has grown about 2.9% per annum. Velocities declined at about 0.2% per annum. So the trend factor is 3.1. You have to subtract that from the real monetary growth, which means we're negative about 4% over the last 4 year annual rate over the last 4 years. So that takes into account the substantial increase in money that we had in 20 and 2021 and the decline that has continued since then. Money has stabilized, turned up a little bit in nominal terms, but in real terms it's still declining. And then you've got the trend factor, which it's not overcoming. So monetary is very, very restrictive. My argument on why the Fed is behind the growth rate is I like to look at what's happening to the 20-year rate of growth in the average of real per capita GDP and GDI. And right now that's under 1.5%, about 1.4%. And that's also where the long-term trend since the 1970s is. So if the Fed achieves its 2% inflation target, which I believe it is well on the way of doing, the inflation rate, excluding the extremely dubious assumptions that the BLS is making with regard to shelter, which is 36% of the component, is already at 2%. And so 1.3, 1.4% rate of growth in real income means that we fundamentally should have 3 1/3 policy rate. We're currently at 5 1/3. And if the Fed overshoots, then it's going to need to go lower. And so we have a condition where both monetary and fiscal policy are inordinately restrictive. And the Fed is behind the curve, which they don't accept that view. They're uncertain about that. And in addition to that, the United States has a very depressed household formation, and also very depressed birth rate, record low birth rate. The economy is in aging in spite of the fact that we've had a massive amount of illegal immigration, and the demographics and debt and growth situations are even worse outside the U.S. than they are inside the U.S. The U.S. is 30, almost 39 years average age. China is 41. In 2 years, they'll be 43. They're aging very, very rapidly. The average age in Europe is 44. The average age in Japan is 49. It's soon going to be 50. These are old economies with low birth rates, low family formation, are not spending economies. I'm a strong believer in the concept that demographics is destiny. And we don't have, and our major trading partners do not have the right demographics for good economic performance. And so we're facing a very delicate situation. And we're here at a time of a national election. And I don't really see, in fact, I think everyone almost would have to agree that the net national saving is going to become even more negative. There are no credible proposals. No one is even considering doing anything about the deficit. And this is no longer an ordinary situation. Now, some people will say that, predictions of the deficit have been not borne fruit. We have not had a crisis, as many have predicted. Well, I have not predicted that. I think the poet T.S. Eliot is really appropriate in here. Eliot said, how does the world end? How does the world end? Not with a bang, but with a whimper. And what this negative net national saving will do what has happened in Japan, what is happening in Europe, now in China, is that it will grind the growth rate down. It doesn't mean that you have to have a crisis. You just slowly lose your trend rate of growth. And that's been exactly what happened. If you go back to 1970, the trend rate of growth for the 100 years before that was 2.3% per annum. We've lost almost 1% of the 2.3. That's a decline of more than 40% of our growth rate. And the decline occurred by such a small amount in any 1 or 5 year period that it didn't really catch anyone's attention. But it has had these profound effects, particularly on demographics. And when you grind the growth rate lower, you exacerbate the income and wealth divides, and society is less healthy. And so the fiscal policies that we're pursuing, in which monetary policy is getting trapped in, got it trapped in a major way during the pandemic, then exacerbate the problems. And so we have serious fundamental issues. The timing of how this works out will remain tricky because there are so many complex factors at work. But the fact of the matter is, the fundamental assessment is this nearly 70-year growth rate of deterioration in our trend of economic performance is going to continue. And it's going to continue in the rest of the world as well.
Okay. Just a packed answer to a very broad question. So you did a great job there.
Sorry you asked it out.
Yeah. Well, look, what I take away from that, and this isn't super news to me because you and I have talked many times in the past, Lacy, but
we've been good friends for a long time.
Yeah. We have. But you look forward and the trend is kind of a grind downwards, right? For a whole bunch of reasons, many of which you've already mentioned here. So it's this just prolonged grind downwards, or maybe it's just the swirling of the drain where it's going to take a while, but we just get closer and closer to the drain as we keep going here.
That's well
And
said. I like the analogy. Very clever, Alan.
well, thank you. We try to do analogies on this channel a lot.
Mhm.
But I think it's important to know that the US has its many challenges, many of which that you just mentioned here, but it sounds like the rest of the world is also going to serve as a weight on the US as well, meaning as poorly as some of the US's outlook or aspects are, the rest of the world sort of has those in spades to a certain extent. And so we can't be looking to the rest of the world to kind of pull us out of our troubles, sort of like the way the West looked to China to get it out of the great financial crisis, to get global growth kickstarted again. It seems like this time the rest of the world is actually going to be retarding our situation as well.
That is exactly the condition, and you're quite correct to bring up the role that China played coming out of the great financial crisis. At that point in time, they were very lightly indebted, and they went on a tremendous debt binge, which this is a classic example of what happens based on the law of diminishing returns. When you begin to increase debt capital, you get increasing returns to scale, or I mean, increasing economic growth. But if you continue to increase debt capital, then you level out. You have flat returns. And then if you continue to increase debt, then you get diminishing returns.
Right.
And you see, but in 2008, China was lowly indebted, and you got the upside, the increasing returns. But now they are in the decreasing returns with all the rest of us. And not only when China greatly expanded their debt in 2008 and 2009, so did many emerging economies, and they have become significantly more indebted. And a lot of the emerging market debt was financed in dollars, and the dollar has generally risen quite a bit, which has raised the cost of funding.
Mm-hmm.
And the world now is not as receptive to the debt of the emerging markets because they've taken on so much debt and their economies are underperforming. And so Europe, Japan, the United States, the major industrialized areas benefited from the Chinese explosion in debt based upon increasing returns. And now they in the emerging markets are in decreasing returns, same as the US.
All right. Brent Johnson should send you a gift basket, Lacy, because you're eloquently making his dollar milkshake theory argument for him here. So we're going to talk more about this, but really what I kind of take from a high level of your observation of the landscape is human nature being what it is. You're generally faced with a choice when you have a challenge, right? You can address the root cause of the challenge and roll up your sleeves and do the hard work. And oftentimes that requires making sacrifices in the short term for the long-term greater good. Or you can take the easy way out, right? You can find the quick fix, right? You can take on more debt, right? Or you can print more money, which oftentimes those two things go hand in hand. Deficit spend, et cetera. And it seems like we're in a cycle of the world where most parties are basically choosing the quick fix, right? And as you said earlier, yeah, that works great in the immediate term, right? But then once you have too much of it and you've started, you've exhausted the quick fixes, but you keep trying to do more of them, the system gets saturated with quick fixes that don't have any good long-term potential. And then you get into the diminishing returns trap, where you keep trying more of the same, and you get less and less, and the problems start to mount and get more and more. Am I accurately sort of describing this? Because we're going to get into policy in a minute, and it seems to me that we've been pursuing the quick fix policy route, and we're at that point where the can is just getting heavier and harder to keep kicking down the road.
Well, that you stated it beautifully, and I wouldn't change anything. The problem is that one of the reasons that the major governments pursue Keynesian economics is because it's been so heavily taught in the major universities. And there's a feeling that they can continue to go to the well. But the situation that Keynes envisioned no longer applies. We do not have a paradox of thrift. It disappears when you have negative net national saving.
Yeah, and can we dig into that just for a quick second? So normally when people are paradox of thrift, if I understand it, is people are experiencing, they're worried about the future, so they start constraining their spending because they want to have some reserves going into an uncertain future. It seems like there's lots of concern about the future. You look at things like, consumer confidence and whatnot, and they're super low. And obviously 3 out of 5 people, if surveyed on the street, say, hey, I don't care what the official numbers say, I feel like I'm in a recession. And yet we have one of the lowest saving rates we've ever had. And on a net national basis, as you've been very rightly pointing out, we've got 5 consecutive quarters of net national negative savings. What has changed this time around?
Well, what was different is that during the pandemic, we coordinated in a very unusual way monetary and fiscal policy. And the Federal Reserve used channels that were really that had not been employed in the past, so that effectively they were monetizing the federal debt. So in this environment, it was able to provide a short-term stimulus to the economy, but inflation is too much money chasing too few goods, and we had the supply disruptions. The aggregate demand curve shifted outward. It went into inflation, but inflation creates all of these consequences, particularly for our modest and moderate income households. The bulk of our people cannot benefit from higher inflation. Mm-hmm. The top decile, maybe the second decile, they do. But everyone else falls behind. So if you look at the real weekly earnings of our full-time hourly and salaried workers, which is about 120 million people, in the past 16 quarters, in other words, coming off the pandemic low, we've declined at 2% per annum. And that has had a devastating impact. And I think that's one of the main reasons that when the University of Michigan surveys people, and keep in mind, Michigan has been surveying since the 1950s. In my opinion, they're the most soundly constructed of all of the confidence measures. The pioneering work of Dr. George Katona, which has been continued on by his predecessors, I think is theoretically the most sound, and based on what people are telling the University of Michigan for many months now, the confidence levels have been below where we entered all the recessions since the end of 1950. And that doesn't surprise me because the real income has fallen. Now, we have had gains in employment, but that has been neutralized by 2 forces in the payroll survey, which, as we've all learned this past week, was badly overstated. Number one, firms have been dramatically reducing the work week. It's come down very dramatically, which was a reason to question why firms were hiring so many people when they were so radically cutting the work. The work week is now below where it was when we entered the GFC in 2007, late 2007. And in addition, at the same time, particularly over the last 10 months, even though this is looking at the household survey, employment declined, but there was a very sharp decline in full-time employment that was actually essentially equivalent to the increase in part-time jobs. But part-time jobs don't give us the same benefit.
Right.
They don't give people the confidence in their future. They don't give them the benefit packages, the retirement, the health, pension benefits, the health benefits as well, and vacation pay and holiday pay and a whole host of other things. And so, the job market was really, it was robust in only a technical sense of the word. And if you took the payroll numbers that the Fed has been, the BLS has been reporting, multiply that times the household employment, which has been declining, and multiply it by the payroll work week, aggregate hours worked year over year is virtually unchanged. And we've just learned that the payroll jobs were overstated by more than 800,000.
Mm-hmm.
BLS has said we're supposed to have a 1/10 of error plus or minus. We had a 5/10 error, 5 sigma error, the largest error since 2009. And so it's now conceivable when we finally get the actual hard data, not just an indication that they've overshot, next February, we'll find that aggregate hours worked in the past year are actually negative. They're not slightly positive. And so the labor markets are not providing satisfaction. And that's why people are concerned. Another thing that has developed here, not a new development at all. The conference board asked people what are their job prospects, and they take a differential of those that expect employment to be better and those that expect job layoffs to increase and so forth. And this labor differential of the conference board declined again in August, and it's now at the lowest level since the pandemic. I mean, the labor markets are not doing well, and people know it, and that's why they tell the surveyors that they're concerned about the situation.
And sorry, let me just make sure I understand you on the conference board differential. You say it's the difference between those that have a positive outlook on the economy and those that have a negative. So sometimes
it has to do with job prospects, whether employment opportunities are increasing or decreasing.
Okay, but I assume it's the difference between those who are optimistic and those who are pessimistic, and in a small differential means they're both either optimistic or both either pessimistic.
It was substantially higher and it's been coming down steadily, and so now, so during the pandemic we were here, and now we went up in that phase when all the stimulus was high, and now we're back to where we were in the pandemic.
Okay, so anyways, just a lower index means people are more pessimistic. That's what I want to make sure I understand.
That's correct. Okay. It's a useful index, but it tells us the same thing as the household employment is telling us, the work week is telling us, and we're now being told that even though all of the databases still are using the flawed payroll data, there is a major error factor of 0.5% in the 12 months ending March of 2024. And so there's multiple confirmations of this deterioration in the labor market.
So let's talk about this for a second. So you and I trade emails, and we were trading emails when this data came out. And you know, in one of those email exchanges, you listed for me all the parade of horribles that you just mentioned here on the employment front, right? And now with the big downward revision in payrolls, that's woken a lot of people up, because up until now, we've pretty much all we've heard has been how resilient and strong the jobs market has been, and pretty much every month has been a beat month of expectations around things like payrolls and job openings. And of course, they would then go back and downward revise all the other previous months, right? But there's been this narrative of a very strong, almost kind of unsinkable jobs market. Now all of a sudden, people are saying, whoa, it's looking like the jobs market was not nearly as strong as we thought. And you've just said, hey, if you were busy looking at all these other indicators, yeah, you would have had a lot of concerns already. But as you said in our email exchange, markets have been trading off of that previously inflated, super robust jobs numbers, right? Those you know, not reflected, more rosy than reality numbers we've had right up until now, have driven the market action. They've also driven policy decisions over the past couple of years. So in many ways, you know, we've sort of had a market and a government that has been flying the plane by faulty instrumentation here. So fast forward to Jackson Hole last week, Powell has come out and basically set the market's expectation of a 100% chance of a rate cut coming next month in September. What do you suspect, what kind of mode do you suspect the Fed is in? Do you think the Fed understands the employment data maybe more so than it's let on, and that's what's driving Powell to try to start cutting rates here? Or is he legitimately confident that, oh, you know, we're going to achieve a soft landing here. Inflation's almost 2%. And we're just going to like slowly edge down in it. Which is it, do you think?
Well, I think that they're too rosy, and I think that they're approaching the problem too timidly. And I think that it's quite conceivable that that the initial path may not be as robust as the markets are expecting, and that will be a shame. And because eventually they're going to have to respond to this weakness. Now, here's one of the difficulties. When you miss payroll employment, we have to recognize that the payroll jobs are used in the computation of a lot of other indicators.
Mm-hmm.
For example, it affects wage and salary income. If you have less people employed, you have less wage and salary income, which means you have less personal income. The personal income is a component of gross domestic income. So we're going to get a downward revision of gross domestic income. It's already been trailing gross domestic product, and it's now going to be pushed even lower as a result of the fact that they missed the payroll job count. Industrial production already shows a cyclical peak as measured by the standards of the National Bureau of Economic Research, who's in charge of cycle dating. But industrial production also relies on those payroll numbers. And here is the situation. The labor market, the Labor Department has told us that we had this big miss. But if you go to their website and you pull down the current series, there's been no adjustment. There will be no correction until next February. Some of the internal numbers are going to be corrected. I just mentioned that aggregate hours work are going to eventually have to be revised downward. Well, productivity is output divided by aggregate hours work, which means that the productivity numbers have been understated. Unit labor cost is wage and salary compensation divided by productivity. So the productivity understatement is going to result in a decline a pushing downward or a downward revision of unit labor cost, which means that the inflationary picture from the cost production side is even better than what we thought. And so when these numbers miss, it causes bad policy decisions, but it also affects the business sector's making of decisions, and as well as the traders in the financial market. And to my way of thinking, this big miss is an indication of bureaucratic failure. I mean, the problems of taking a very small sample and trying to rev it up from the payroll survey is based on a survey of 670,000 firms. And the sample is not mandatory to the firms that it go to. So in a typical month, we often get well less than half of the firms returning the survey. The quarterly census of employment and wages is a survey of 11.2 million firms. And they're not doing a good job of extrapolating from this limited small sample to the total picture. And we've known of this problem, but they haven't been able to fix it. They said that they fixed it in 2009 after the huge miss, but they haven't fixed it. And there's really no plan. So here is one area where we have a massive $2 trillion budget deficit, and in a critical area that's important for execution of monetary and fiscal policy, business planning, investment decisions, the government cannot give us proper data and give a reflection of where the economy stands. And so the fact of the matter is, I understand where all of the areas that are going to be influenced as these revisions come through, but it's not possible for me to correct the numbers. I have to wait until February of next year. I can do it in a very general sort of way, but there's no way for a private type participant to be able to make the complicated changes in a consistent manner. We need the government to do that job. And the fact of the matter is they're failing very badly. And there seems to be no concern whatsoever of this. And that's the situation that we're in.
Okay, so two questions for this, and then I got a few big other questions I want to move on to make sure we have enough time to talk about. But first one's very small, second one's really big. This may be a naive question, but I didn't even know about the QCEW until 6 months ago or so, when people really started talking about how hard to swallow a lot of the BLS payroll data was. And that does seem to be a much better source of truth. Why don't we just make it an MCEW, right? Go from quarterly to monthly and forget about the BLS payroll data.
Just use that. They could absolutely do that. And I don't know why they're not. I think personally, if they're not willing to try to collect the data monthly, they probably should only release the employment data quarterly, five months after it would be 5 months later than we're getting it now. But it'd be better to have the actual numbers rather than
right.
to try to guess it and be off the mark.
Better to have good data late than bad data on time.
Yeah, that's my personal view. And if people have other arguments, that's fine, but that's the way I think about it. Why mislead people?
Right, but it just seems like we have a perfectly good option.
All we are going to know is the situation 5 months ago, then so be it. Then we have to operate with it.
And I guess they'd take that over what we have right now, but it feels like we have this perfectly good quarterly solution. Why not just run the same methodology more frequently, and then everybody gets.
I think that should be done. And another thing that would be really, really helpful is all that they have done with the QCEW is that they have given us the raw numbers. They have not given us the numbers seasonally adjusted. And some of the folks that actually calculated the revision based on going from the NSA payroll to the NSA QCEW found that there was a miss of over 900,000. The Bureau of Labor Statistics said the miss was slightly more than 800,000. Well, it seems, maybe I'm wrong on this, but it seems that they have an internal seasonally adjusted series that they obtain the 800 figure from. Well, if they have a seasonally adjusted figure internally, that should be released.
Mm-hmm.
They shouldn't just leave us with the NSA numbers, which is all we have. So the fact of the matter is, there's more that the Labor Department could do with the data that they already have, and they're not doing it.
Okay, so for better or worse, we currently have the system that we have. It's giving us imperfect information. Lots of decisions have already been made off of this imperfect decision, the imperfect data. Investment decisions, policy decisions, corporate allocation decisions. So my takeaway from what you're saying here is that you expect there to be some sort of reckoning, some sort of shoe to drop in the future from all of this, right? Where we've basically been making decisions that aren't accurate based on reality. And so, you know, and because the numbers were more rosy than what we're determining the reality probably is, there's probably some market overvaluation that's going to have to correct. There are going to be some corporate investments that were misallocated based on this, and policy is not the best fit for the future we're heading into. Like you said, you think the Fed is behind the curve, largely because it's been looking at data that said things were better than maybe they really are. So is this true? Do you expect some sort of shoe to drop from all this?
Yes, but the fact of the matter is, in an important sense, the shoe's already dropped. I mean, we mentioned the work week, we mentioned the conference board series, the general attitude of folks about the labor market. But there is the unemployment rate itself, which is the household survey. At its low point, the unemployment rate was 3.4%. It's now 4.3. Well, that's an increase in the unemployment rate of 26%. Historically, according to the first-rate economist Nancy Lazar, Piper Sandler, in the past, we've had recessions whenever the unemployment rate increased by more than 10% from its low.
Yeah.
And then there's the Somme rule and the McKelvey rule, which was really the Somme rule was drawn from. Both of them show that the McKelvey rule shows outright that the unemployment rate has hit the mark that typically is associated with recessions. The Somme rule, there's a little dispute as to whether or not it currently has or has not, but it's certainly very close. So the fact of the matter is, you have a whole plethora of variables, but the one that the market has been trained to accept as the gospel is the payroll number. And so the number when it comes out for August here and in early September is still going to be just as flawed as the number that was released for July, because there's no correction of the underlying problem, none whatsoever.
Okay. So to my question, then maybe the reckoning is a dawning, an awareness that, oh, you know what? We were all hoping for a no/soft landing. It's got to be something harder, right? And then that sentiment shift changes, all of a sudden, a whole bunch of things people didn't imagine were possible all of a sudden become considerable.
Before you go any further, let me just, let's look at several critical areas. Let's look at vehicle sales, existing home sales, and new home sales. The current level versus their 5-year peak. The vehicle sales are down 13%, and the new and existing home sales are down 37%. I mean, That's a very significant decline.
Yep.
It's larger than a typical decline during a recession. Another thing that's happened, which is a reflection of not only domestic conditions, but conditions overseas, is that in real terms, the current account deficit, or net exports in goods and services, in the latest month is 8.5% deeper than it was a year ago. That's a high multiplier sector. You already have components of the economy which shows deep declines. And the presumption is that those sectors are doing well, when in fact they are not, in my opinion. Okay, I'm sorry I interrupted you, Adam.
No. I think you're adding validation to the point I was making, which is, and again, I'm not trying to put words in your mouth. I'm just trying to make sure I understand you, which is you're saying, look, we are still currently largely telling ourselves everything's fine, but I believe that you think at some point we're going to not be able to deny the data anymore, or the unfolding reality, and our perception is going to shift from, okay, actually things aren't fine anymore, and we got to maybe start assuming, I don't want to say crash position, I don't want to be too alarmist, but we got to prepare for harder times than we are currently thinking lie ahead.
Yeah, so in fact, there's one other series that I should mention, and that's capital spending. There's a very critical component that comes out monthly with the durable goods report, and it's called capital goods shipments excluding defense and air. All right, non-defense capital goods shipments excluding the commercial aircraft. A very key component that feeds right into the national income and product accounts. What we saw with the July numbers, there was a big increase in headline numbers because of defense orders and what have you. But the numbers for the second quarter for non-defense capital goods shipments ex air was revised lower, and the July number in nominal dollars is below what it was in the second quarter, and in inflation adjusted, it's even more significantly lower. And so you're not only seeing these high multiplier consumer sectors where there is a downturn, but we're seeing it in CapEx. And one of the things that I noticed was that there was weakness in the high tech sector in both June and July in terms of the actual shipments, which is totally contrary to the notion that most people have, that the high tech sector is still flying high. Well, in the Commerce Department data, we didn't see that in the last 2 months, and I think that's a significant development in itself. And think of what the impact would be if the corporate tax rate goes to 28%.
Okay, well, hey, on that, I've got two big questions left to ask you. That's related to one of them, which is, what's your opinion, looking through the lens of economic theory on the economic platforms of the two presidential candidates? But real quickly, before we get to that, another question that I think is going to weigh large on many investors' minds in the coming future. I mentioned this in the introduction. If the Fed is now in rate cut mode and it starts bringing down the effective federal funds rate, many people like yourself talk about or remind us a lot that the Fed controls the short end of the yield curve. The market controls the long end of the yield curve. So a lot of people right now who have been uncomfortable with the economic outlook and with the perceived levels of overvaluation in the equities market have done the T-bill trade. Some call it T-bill and chill, right? So they've either parked their capital in T-bills or bought into money market funds. They're getting 5+%, and they're sitting in safety. They're sitting in the safest financial assets that are out there. And many have been doing that with a sense of relief, because for much of the period between the great financial crisis and just a few years ago, you couldn't get any return. It's practically zero in those instruments. So finally, there's an option for people that just want to sit on the sidelines in safety, right, and get paid a positive return. So that game is going to start ending, right, as the Fed begins to bring down the federal funds rate. And they're going to be faced with a choice. Well, what do I do with this capital here, right? I'm now not getting the return I was getting before. Where else should I put this money? Some of it's probably going to go in all sorts of different assets, but as I look at the situation, I think probably a material part of it is going to say, hey, I liked sitting in relative safety and getting a decent yield. So I'm going to go out the yield curve now and try to lock in these rates, try to lock in at least a 4% or a high 3%, in a 5 or 10-year treasury. Do you see similarly? Do you see something else? But this to me seems like it could be quite bullish for longer duration,
I think
at
it
least
will
US
in due
treasuries.
course. I think it will be in due course. And I think in due course, the Fed is going to have to cut the rates more significantly than they think they are going to. I think ultimately the neutral rate is, as I said, the real per capita growth rate, which is 1.3, and a 2% inflation rate suggests a low 3 number. But if the Fed proceeds in a very irregular fashion, or if they waver from time to time, or if they cut the rates and indicate that their view on the outlook is still indeterminate, people may continue to say, well, 5 1/8 is not 5 3/8, but it's still a pretty good return. It may not result in any sort of rapid shift. It may require a greater degree of indication from the Fed as to how they see the picture. And so it could be a very long, drawn out process. As an investor, that the long-term process is what I'm concentrating on. But to those that try to trade it, it could be much trickier.
Okay, so again, when I hear from you there, sort of an answer of like, yes, it's likely to be bullish for longer duration bonds, particularly treasuries, but it may take a while before it is. It may take a couple of rate cuts before people abandon these short-term T-bills.
That's what I would say. I think that's a fair interpretation. Maybe even longer. It depends upon the peripheral statement and that the Fed gives to the market.
Okay, well, something to watch closely, but I personally think that if the Fed does start bringing interest rates down, there will be some threshold, and we don't know whether it's one rate cut or 4 or 5.
Especially, and keep in mind that, and this is important too, it's not the nominal federal funds rate that matters, it's the real federal funds rate that matters.
Okay, yeah.
Inflation rate is coming down, which means that the real federal funds rate is actually rising. And so a 1/4 cut, all that really does is partially neutralize the reduction in the increase in the real rate that has occurred when the nominal rate was unchanged and the inflation rate was coming down. Mm-hmm. And so I think that also suggests the Fed is behind the curve.
Okay, and of course, history shows us when the Fed is behind the curve, it usually gets to a point where it scrambles to try to catch up.
Correct. That phase is ahead of us.
Yeah, and presumably that phase
is always there.
Okay, and that'll be very bullish for long duration treasuries when that happens.
The situation.
Yeah,
timing is tricky, but it is going to be there, in my opinion.
Okay, and again, and I'm asking you this because your firm focuses a lot on treasuries. That phase you would expect to be quite bullish for long duration treasuries.
I do, and we're positioned for that.
Okay. All right. So last big question here. We've chopped a lot of wood so far, Lacy. Congrats.
Well, you're a great listener, Adam.
Oh, it's just a joy for me. All I do is just wind you up and then listen.
You're very popular. I hear your name everywhere I go.
Oh, well, thank you. That's that is a huge compliment coming from Lacy Hunt. Thank you. Now you got me blushing. Okay, but to the question I mentioned about the economic policies of the candidates, we're going to do this in a nonpartisan way, folks. We're literally just going to look at this sort of clinically from an economist's eye. You made a comment earlier about the net national savings, which was depressing, where you said, hey, looking at the policies of both parties, looks like that's going to be getting worse no matter who gets elected in November. But as you look at Trump and Harris's stated economic policies so far, what implications would you expect from each party?
Well, both are proposing increases in the national debt, and that will send us further down the law of diminishing returns. And it's really not clear to me who has the plan to increase the debt the most, but both of them have big plans, expensive plans, and no effective way to pay for them. Now, with regard to the increase in the corporate tax rate to 28, increase in capital gains rates, not just on realized, but on unrealized gains, we have to remember several things. First of all, capital is mobile. Capital doesn't stay in the United States because we're pretty. It stays in the United States because the after-tax rates of return are attractive.
Right. And sorry to interrupt, but just key point, money goes where it's treated well.
That is,
So it comes here because it relatively been treated well, but if we don't treat it well, it's going to go somewhere else.
a 28% tax rate, according to the research of Nancy Lazar, will give us the highest corp rate for any country except Colombia, which is a very minor country. It's so, but in addition to that, if you raise the corporate tax rate, you raise the cost of production. So when you raise the cost of production, then firms will attempt to raise prices. In the current environment, they're not going to be able to raise prices because money supply on a detrended basis is declining, which means that this will impinge their profit margins. So in short order, as a result of the corporate tax increase, it will force firms to relocate their capital overseas. That's what they will do.
Okay. And just to note, I live in California, you live in Texas. We've been seeing this happen inside our country, where a lot of companies from my state have been going to your state.
Yeah, because we're a low tax state. Same is true of Florida and Tennessee and the other low tax states. They're benefiting very substantially, and we're seeing a huge dichotomy in the performance of the high versus the low tax states, which is an indication that even though it's difficult, capital will move, and it will move within the side of the United States, but it will also move from the United States overseas. Well, it's capital that creates jobs. It's capital that creates prosperity. So if you want to tax it and say you're going to help pay for some of these benefits, the fact of the matter is it's not clear that the higher corporate tax rate after a few years will generate more revenue. I would say will generate less revenue than if you had done nothing. So we're basically locked in. Another thing that concerns me is wage and price controls, or price controls. Not so much wage, but let's just consider price controls, and one of the fundamental laws of economics is the law of supply. And it says if the quantity supplied is positively related to the price. So if you lower the price, the quantity supplied will decline. There's a positive correlation. That's the law of supply. The law of demand is inverse to price. You raise the price, the quantity demanded declines. So when you lower the price, the supply that is going to be provided is going to go down, and there will be greater demand. But that means that the gap between quantity supplied and quantity demanded will be greater, which means you created a situation that then demands in the second phase, not in the first phase, but in the second phase, higher prices. And so you end up with higher inflation. And if the Federal Reserve did what it did when President Nixon imposed price controls in the 1970s, then you will shift the nominal demand curve out, and you'll get higher inflation from creating a shortage of goods as well as from the printing of money.
And just to make sure folks understand, the shortage of goods really manifests because you're putting price caps in there, you are creating a disincentive to the producers to produce. So they curtail production, demand goes up because prices are
temporarily low. It's just a first round effect.
Right.
Anyone that thinks that wage and price controls are beneficial, they are only momentarily. Because when you lower the quantity supplied, you get a reduction. When you lower the price, you get a reduction in the quantity supplied, but you're simultaneously getting an increase in the quantity demand, and consequently the fundamental gap between quantity supplied and quantity demanded gets greater, and you have a shortage.
Yep. And
so fundamentally then, whatever short-term benefit there is in imposing the price controls, you lose it and you go to higher prices until the market price is restored. And so fundamentally, it puts the economy in a highly unstable situation. And if the Federal Reserve, let's say they lower the inflation rate because of the first round effects of the price controls, and the Fed revs up the money supply, then you've made the situation even worse. Mm-hmm. Which is what happened in 1972 when Richard Nixon was president, and Arthur Burns, who was chairman of the Wage and Price Control Committee, incredible situation, accelerated the money supply growth, and effects were very, very harmful. And it after about a year, 6-9 months, the wage and price control started failing, and then Nixon then withdrew them, and then the inflation rate shot up very, very dramatically.
So Lacy, we can, I mean, history is replete with examples of how these things don't work. And in fact, in
the United States, but the reason that's complete is because of this is in contradiction of the law of supply and demand.
Right.
So it's basically saying you don't believe in the law of supply and demand, which has never been disproved. Never.
Right. I was going to say, I think you said before we turned the camera on, you don't have a single example where it's actually ever worked in the long term. And I think everybody who has a remote background in economics understands why and agrees with you. My only point was going to be, just like I made the comparison of California and Texas, we can just look a few miles off our southern border at Cuba right now, which is in a real crisis stage at this point, largely because of policies like these, correct?
Yeah, and actually, what we're now seeing in Texas is that the movement is not into the big cities, Houston and Dallas. Sometimes the press stories will say they're moving to Houston, but they're actually moving outside of Houston. Chevron, for example, is moving their headquarters, but they're not moving it to Harris County. They're moving it to one of the adjacent counties and to an adjacent municipal government, because the taxes in Harris County are incrementally higher.
Okay, so just proving the point. Yeah,
it's even happening when you look carefully at the movement of firms to Texas. They're beginning to ignore the big cities that have the higher tax rates.
Yeah, which should be a surprise to know.
It's the law of supply and demand working, and so And by the way, the performance of the large cities in Texas is now beginning to suffer.
Okay. Again, not a huge surprise. Seems like a fairly predictable outcome. So price controls, increases in the corporate tax rate, increases in the capital gains tax rate. Those are, those are part of the Harris platform right now. On the Trump side, he's generally much for much lower taxation, but tariffs are a big part of his platform. What do you have to say about the Trump side?
Totally opposed to raising tariffs. It's the law. It's a contradiction of the law of comparative advantage. You raise the tariffs in any significant way, you force retaliation. It's an ill-advised policy. It's as ill-advised as instituting wage and price controls. I mean, it's so contradictory to fundamental economics to do either one of them. But it's an indication of where these two parties are now. They're not where they used to be.
Okay, so through your economic lens, you're not very optimistic from an economic
I don't
standpoint.
think the presidential election addresses the problems. Neither one of the party, and in many respects, they're proposing programs that will make situation worse than better.
Is there any chance that we've got enough time left to get a Lacy Hunt on the ballot as a third party candidate here?
Yeah, at 82, I'm out of the picture. Keep in mind, I was born in 1942, the same year as Joe Biden. So he hasn't quite turned 82. I already am. So,
well, you know what? I could look past that, Lacy. Let me just say
okay.
the data point of one.
I thank you.
All right. Well, look, Lacy, this has been, as usual, a phenomenal hour with you. Thank you so much for coming on, giving so much yourself, just for doing what you do too at 82, out there still working hard to help open people's eyes about the true state of the data and the types of policies that we should be pursuing. I hate to do this. I'm going to have to start wrapping things up. I am very excited, though, that we'll continue this conversation in October at the conference. For folks that would like to follow you and your work in between now and the conference, where should they go?
I don't want to do any advertising, so I'm not going to. You can go on our website and get our quarterly letter. That's all I can do. But
all right,
I'm not advocating that they do that, because that would be advertising, and I'm not supposed to do that. So,
okay. Is it okay if I advocate that people go check out Hoisington if they're interested in Lacy Hunt?
Well, thank you.
Also, folks, too, just Google Lacy Hunt. There's a lot of Lacy interviews out there. You can go listen to them there. And of course, you can see Lacy at the Thoughtful Money Conference.
I have a really special speech planned. I may have to revise it several times between now and October 19th. But I'll try to make it as interesting as I possibly can.
Well, thank you. I'm super excited to hear that, as I'm sure the viewers are. And let me say, Lacy, don't overwork it too much. One, because I don't want you to work too hard on it. But two, I would say when in doubt, just leave more in. Like if you're feeling you need folks just want more Lacy, so feel free to let it run long.
Okay.
All right, and folks, if you're interested in seeing that, please go to thoughtfulmoney.com/conference. And if you go now, you'll lock in the early bird discount price, which is the lowest price we're offering. And a reminder, if you are a subscriber to Thoughtful Money's Substack, you'll also get an additional $50 discount off of the ticket price. Lacy, it's just always such a pleasure to talk to you. Thank you so much, my friend.
My pleasure. All the best. Have a great rest of your summer.
All right, well, now's the time when the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners Mike Preston and John Lodra. Gentlemen, thanks so much for joining me. Always just a phenomenal discussion, talking with a mind like Lacy Hunt. John, let's start with you. What were some of your key reactions to that discussion?
Hey, Adam. Well, geez, we love when Lacy comes on your program, because he's one of several very esteemed veterans that really take a kind of project a sage wisdom that doesn't always come through in many strategists that you'll see on the talk, on the airwaves. He brings a data-driven basis for the observations he makes. He'll be the first to point out that economic signals have certain amount of slowness in transmitting to markets and things like that. And in fact, he calls out the fact that politicians are inherently short-sighted, and many of the policies that they promulgate are absolutely at odds with what the economic cycle readings would otherwise suggest. So, for example, he talks about the really unprecedented situation that we have right now with 5 quarters of very soundly negative net annual savings, national savings. And the only other time that that's happened is in the Great Depression, I think for 4 years and 3 years, or the quarters, I think, and 3 quarters during the Great Financial Crisis. Never has it happened in an economy that's been as strong, even with the data peculiarities that have come through with job reports and things like that. And what that has done is it's really upheaved one of the very foundations of Keynesian economics that rules the world. All the politicians, all the economists are trained in the school of Keynesian economics, where this idea, this concept called the paradox of thrift, that when things start to get worrisome, that individuals acting in their own best interest will start to save more. They'll be more cautious, more, put their pocketbooks away. And it's government's job to step in and do the spending because it's almost like a virtuous negative cycle when individuals acting in their best interest start to pull in their spending, it can cause a death spiral, so to speak, because it has this negative multiplying effect on the economy. And that's traditionally why government would spend to offset that. But right now, there is no savings. There's negative savings. So the whole mechanism by which governments would typically come in and counteract that paradox of thrift is missing. So he really raises, I think, a real sober, rightfully sober tone about what's going on here, and calls out the massive amount of fiscal deficit spending at perhaps the wrong time, especially given that net negative savings. He does point out, without taking any political sides, that at least the 2 primary candidates in the upcoming presidential election seem to be proffering policies that would continue and probably exacerbate that kind of deficit spending. So he does paint a very stark contradiction between short-term politicalism and what the economic cycle should demand. Before taking a pause here, I just also want to make a call out to a great interview you did with Dr. Honig that aired right after the Jackson Hole meeting. I think the 2 of them exemplify real objective sage wisdom when it comes to the economic cycles. They're not exactly on the same page in terms of likely and maybe prudent interest rate path, but that's okay. Nothing here is with precision and 100% agreement. But they're founded in very, I think, strong observations by both of them.
Thanks. Yeah, this week has been an embarrassment of riches. To be able to interview those 2 giants back to back has been just a massive privilege. And I'm excited because tomorrow I'll be interviewing Neil Howe as well. So I feel like this is just kind of a week of giants. And yeah, it's interesting you highlight some of the differences between Lacy and Dr. Honig. And I mean, I think they agree on so many more issues than they disagree. But my kind of quick takeaway is that Dr. Honig is like, look, we just got to make sure the inflation dragon is completely dead. And, higher for longer interest rates is the better path to do that. So I don't think the Fed should be cutting all that much. I don't think they should be jawboning so much. They shouldn't be setting expectations for a lot of rate cuts, because then that'll stoke animal spirits again and maybe revive inflation before it's fully dead. And I think Lacy kind of looks at the inflation deflation debate as like a bull elephant that's been mortally wounded. It's still stomping around a bit, but the kill shot's already been made, and that thing's going to topple over at some point. So I think he feels much more confident that economy is going to slow, things are going to grind downwards. Don't worry so much about inflation at this point because that elephant's dead. It just doesn't know it yet. All right. So before we turn the camera on, John, you mentioned you had some data that you might want to pull up right now, which is basically just the number of interest rates that the market seems to be pricing in right now. Let you talk about that for a second, and then it raises a really important question. I think is going to be on the lips of many investors very soon. I think a lot of them just haven't really thought of it yet. So do you want to pull that data up?
Sure. I'll share a screen here. This is perhaps a familiar screen. We've shared it many times. I know other folks on your program have. But this is what's called the CME FedWatch tool. It's basically a measure of the market's collective implied probability for a certain rate path. So just a little bit of a tour here. You have along this column, the dates of the upcoming Fed meetings. Along the horizontal row here, you have the target ranges for the federal funds rate. We are currently at a rate, and have been since July of 2023, of 5.25 to 5.5. So what this is showing, so here's the upcoming meeting, September 18th. It's showing that the only scenario that the market is pricing in is with the highest probability, a 63.5% probability, that the Fed will drop 1/4 point at the September meeting. But the market is also pricing in a 36.5% probability that they'll do 2/4 point drops, so a full 0.5% drop at the September meeting. Now, I do want to point out that just not even a month ago, earlier this month, when the markets were in free fall, and August 5th was the day that many people, certainly in our seats, we can remember with vivid, because it felt like a little bit of a mini meltdown on a lot of different factors. But that was over 80%. At that time, the market was pricing in over 80% probability of a full 50 basis point drop. But the path here is, you can kind of look at what the implied path. All these blue boxes are the most probable level at the meeting. So you can see, for example, by December meeting this year, the market is pricing in a 4.25 to 4.5 range as the highest probability. There's some probability they'll cut more than that, some probability they won't cut as much as that. But that's a full percentage point drop come December. That's a little bit ahead of where the Fed has traditionally been. They've, I think, still been, when they have talked about forward path, talked about maybe 0.75% cuts this year. So the market's pricing in 4. And then just to plug back to Dr. Hunt's, Lacy Hunt's presentation, he thinks the neutral rate should be closer to 3 1/3 right now. Well, if we go out to that would be right here. By July of next year, the market is pricing in 3.25 to 3.5, essentially right where Dr. Hunt talked about, with the highest probability. So the market's not too far off of pricing in a rather rapid rate trajectory in line with what Dr. Hunt talked about. To contrast that, Dr. Honing was very much of the mind that at the upcoming September meeting, the Fed should drop rates, maybe 1/4 point, but be very careful about messaging too much of the future, and certainly how much of a path to the future, because the market has tended to get this wrong a bunch of times and overshoot. And one of the big criticisms that Dr. Honing had was that the Fed's forward guidance has, as well-meaning as it's been to let the talking do the work for you, the market has oftentimes taken that bit in its teeth and run amok with it. And he thinks there's a risk of that happening again. So yeah, we're one final point I'd like to make is, while the bond market and the interest rate markets are pricing in this, and I don't see this kind of rate path under a soft landing scenario. Yet the stock market is still pricing in, a no landing or a soft landing, certainly not a recession, because we're near, essentially at all-time highs or above all-time highs, depending on what index you're looking at. Many sectors are at all-time highs. We think there's probably reckoning, and certainly the market's not pricing out, in our opinion, a recessionary type of scenario. And there are implications for what that likely would mean for different asset classes.
Okay. So big differential right now between what the bond market or the interest rate outlook is telling us versus what the markets are. And I just want to acknowledge that the time we're recording this, is a few hours before NVIDIA comes out and gives its earnings report and forecast. And that could be a game changer. Who knows? Folks watching this video will know by the time this video comes out. Either one of two things is going to happen. Either the bond market's going to prove to be wrong, we'll have a soft landing, and the stock market will be proven right, or vice versa. I do want to note, in history, when those two have diverged, it is much more often than not the bond market is proven right. But we'll see. So okay, so that interest rate forecast that you put up, I think, super helpful, because it raises a very important question. I would say one of the most popular trades of the past 2 years, especially for many people in this viewing audience, has been the T-bill and chill trade, right? I think stocks are richly valued. I think maybe the economy is a little bit weaker than we're being told. And so I'm just going to sit in safety in T-bills, or in a money market fund that's invested in T-bills. And I'm going to collect my, 5.25%, right? And boy, we haven't really had the chance to get paid to sit in safety until recently. And man, it feels kind of nice, to be just sort of on the sidelines, out of the craziness, and getting a relatively decent return on my money, right? Well, if the Fed indeed cuts on the schedule that the current interest rate forecasts suggest it will, that T-bill and chill trade is going to come to an end. Right? People are, all of a sudden, as their T-bills roll over, they're going to see they're going to be getting lower and lower yields on those T-bills. And there are trillions parked that have been moved into T-bills and money market funds over the past 2 years. All that money is going to have to decide, what do I want to do about this? Do I just want to keep riding this sort of sinking balloon, or do I want to go somewhere else? And my opinion is there's some threshold, and I talked a little bit about this with Dr. Hunt. There's some threshold, probably more than just 1 or 2 cuts, but at some point, those investors are going to realize, well, wait a minute, if I keep just sitting parked here in T-bills, yeah, I'm going to ride these yields down, and then I'm just going to have lost that opportunity. So where else can I go? And I'm sure money will go into all sorts of different places, but I imagine a pretty material chunk is going to say, I've kind of liked getting paid to sit in safety. So how can I do that? Well, I can move out the duration curve on these bonds, and I can get into a 2-year or a 5-year or a 10-year bond and lock in whatever yield I'm going to be able to get for a lot longer, right? It's not going to be a tasty 5% yield probably, but maybe if I can get a 4 or a high 3s, yeah, I'll do that. And they also have the expectation that, or the potential that if I start doing that relatively soon, and those interest rate forecasts turn out to be correct, and the Fed basically reduces the federal funds rate by 200 basis points in the next year, you're going to get some nice appreciation from these bonds the further you go out in the duration curve. So my question to you guys is, and I'll start with you, John, then we'll come to you, Mike, is, what do you guys think? I mean, is this expectation of declining interest rates at the schedule going forward bullish for long-dated bonds?
Yeah, on a relative basis, certainly a dropping short-term rate does make more appealing some extension of duration. As we sit here today, we're recording this on August 28th. The 2-year yield is at 3.86. 10-year yield is only 3 basis points lower than that. We are I think the closest we've seen in recent times, maybe in this cycle, of the 2-10 uninverting, which we've talked about a lot, about the uninversion of a yield curve, is classically a harbinger of recession. So yeah, it's a tricky thing. We tend to favor a little bit more the belly of the curve right now than the long end, because getting back to this deficit spending, there is a real headwind for longer term bonds, and especially if the Fed starts to reduce its balance sheet in a more earnest way. That we may see the rallies in the belly of the curve more so than the long end, because of buyers' concerns about the fiscal situation in the U.S. We'll take a measured view, and we'll let the market and technical speak to us. But the other point I want to make, one of the very prime reasons we hold short-term treasuries is because of their liquidity and their ability to essentially have an option value to jump into other things that are more attractively priced. So yes, one part of that will very likely be extension of duration. We have a T-bill coming due in early September, and we're already at this point thinking that we'll probably extend duration on that, maybe go out 2 years, something like that. We'll see when we get there. But if I think our base case is if we see the kind of rate declines that are priced into the market, they will likely be accompanied with a stock market that has fallen off pretty dramatically. So there very well may be a good case, and we'll certainly be looking for this, to deploy some of that dry powder into much more favorably priced assets or sectors that have taken a hit, whether it's because of recessionary type things taking hold. But point being is the play is not just extension of duration, but it's also probably, if we see these kinds of rate cuts that are priced in, that other things are going to be looking a lot more compelling too, like stocks broadly.
So it's a great point, and it's interesting because yes, the optionality value of just being in something super liquid, like a month T-bill or whatever that keeps rolling over, is if better valuations appear in other things, you can quickly deploy those assets into them and buy them. At the same time, the people that are considering going out in duration, as I mentioned, declining interest rates should help them there. But if that turns out to be commensurate with a market correction, right, which history generally shows is kind of the way that it happens, right? Fed hikes too much, hangs out for too long. We enter a recession, markets correct, the Fed starts scrambling and cutting rates, right? If that script played out from here, I don't think it would surprise too many people. But then that would add a fear trade onto long durated treasuries. People would want safety, and that would drive the price even higher of those. So, it's interesting. It's almost sort of like I can benefit from staying super liquid, or I can move out on the duration curve and benefit from the double barrel of declining interest rates and flight to safety. And you can still sell your 2 or 5 or 10-year treasury bonds anytime you want. They're still pretty liquid too, right? So it's a very interesting time. That's a big question that a lot of people are just going to have to start asking as these rates come down. That's why I wanted to put it on the radar here.
No doubt about it. Things are getting more interesting. The tactical opportunities are probably getting much more plentiful and more tricky, candidly. So we think it's going to be an interesting time ahead as this rate path starts to unfold.
And folks, this is why so many people who appear on this program have been saying that they think an active approach is going to benefit investors much more going forward than this traditional passive one, for the exact reasons that John just mentioned there. All right, Mike, coming to you. Thanks for being patient. Anything that you want to add into this discussion?
I think I'd like to just say something on T-bill and chill. I mean, there's nothing wrong inherently with T-bill and chill. We've been saying for a long time here, with short-term treasury bills at 5%, it's hard to go wrong. In fact, we got a good chunk, almost, a little over a third in treasuries. Not all short-term, they're mid-term and some out to a couple of years. But overall, there's nothing really wrong with that. The problem I see with that is that will change at some time. As Lacy pointed out, in due course, I think he said, the Fed will cut a lot more than expected. John just pointed out that the market expects maybe around a 2% drop between now and the end of 2025. I think that Lacy is hinting at the fact that they might drop even more than that. He says a normal interest rate right now would be around 3 1/3. I wouldn't be surprised to see the Fed drop a lot more than that, particularly in response to a crisis. We've been saying here that we expect the 10-year to go below 3%. I wouldn't be surprised to see the 10-year go to 2%. And so, the Fed is probably going to cut more than expected. And that is going to be very good for long treasuries, and I don't think that long dated and even medium dated treasuries have really reflected that fact yet. We've got ETFs like TLT flirting with 100 right now, but that's off a low of the mid to high 80s. It's bounced, but not that much in light of the change we've seen in interest rate expectations over the last month or two. So mid to long-term treasuries is still a very good opportunity, even at these prices, and it seems like Lacy agrees. But the other thing about T-bill and chill is that he also said here, just reading my notes, that investors don't normally move off of T-bills until there's several rate cuts, meaning they're going to probably let those T-bill rates go from 5 to 4 to 3 to 2. Eventually, at some point, they're going to get sick of T-bills. They're probably going to be slow. And what are they going to be faced with, in my opinion? A hyper overvalued stock market. I know that you've had John Hussman on your program. We've talked about his models. His models that we think are very good show that the S&P would have to be around 1,800 or so to produce 8 to 10% returns. At these levels, we can expect negative returns. And so imagine with the S&P at 5,600 here, and we fully expect it to go perhaps even higher in what we would expect to be a further blow off top, maybe to 6,000, something like that. Though we wouldn't trade on that or take risks based on that. That's just what our experience tells us is likely to happen. But here we are at 5,600. If we went to 1,800, that's a drop of at least 2/3, even if we went higher and then collapsed from there. So imagine this. Investors are all in T-bills and rates go from 5 to 4 to 3. And they're like, oh, you know what? The stock market pulled back 15%. Let's go into it there at 4,800. Well, what if it drops from 4,800 to 4,000, then from 4 to 3, and so on and so forth? The biggest risk, in my opinion, is going to be for people coming out of safe T-bills into the market without a plan. They're going to need a plan. And we have a plan to layer into the market with hedges and to collect premium on options. And I think it's one of the bigger, one of the biggest values that we'll offer to people in the coming years. Maybe in the coming year, we'll see. But that's going to be the biggest thing. Nothing wrong with sitting in T-bill and chill right now. Be careful of what you do next, because coming out of those T-bills is going to be treacherous, in my opinion.
Great point, and underscores John's thing that things are becoming a lot more interesting, but a lot trickier, right? The calls are getting harder to make. All right. Well, look, we've got a little bit less time this week, guys, so we're going to start wrapping up. Mike, since I went a little bit long with John, is there anything else that you want to talk about? Maybe give a quick nod to, I don't know, the precious metals or anything else that's catching your interest?
A couple other things. One other thing that Lacy said is that both parties, Democrats and Republicans, are in favor of more debt. That's not going to change. It's been that way all the way back to Ronald Reagan. Actually, it's been nothing but expanding debt. So it doesn't really matter who wins. It's going to be more. And the Fed is going to do that. And so that's what I expect, is that money printing to absolutely explode in the next financial crisis. And the treacherous thing is going to be when to get in. So we're happy to talk to people about that. Gold has been sitting around right around that 2,500 target that we've been talking about. It's down a little bit today. Silver's lagging a little bit, but don't get discouraged with gold, and don't get discouraged with miners. Miners have been doing better. They're on a little bit of a pullback today, but gold sitting here at 2,500. We think that gold could push as high as 3,000 in the next 6 months or so, before maybe pulling back to the levels that we're at today. Silver at 29 could go as high as 35 to 40 during that time. And the miners should play catch up. That's not to say to overexpose yourself. In fact, we will probably begin rebalancing accounts if we see a further push up in miners. We've got a 10% allocation in our model, and we think it's a good allocation. And we've got some hedges that will probably apply if we move higher as well. But gold here at 25 is still not overvalued. Perhaps it'll go as high as 3,000 before trading in that new range of 2,500 to 3,000. And silver should be in a new range of maybe 33 to 40 over the next year if gold does what I just said. So great opportunities there still for people that don't own it. For people that are overexposed, and we're already talking to some of those people, you can dollar cost average into those price increases, into those levels that I just talked about. So still very bullish on the miners and gold.
All right, thanks. And I really appreciate you mentioning the rebalancing and being transparent about your guys' plans to do so. That's one thing I see that a lot of regular individual investors fail to do. You kind of begin to fall in love with a position. Oh gosh, look, this stock keeps going up. I bought it at 5% of my portfolio. I thought that was the right allocation. Now it's 8 or 10 or 12 or whatever. And wow, what a great winner. And I just want to keep riding this thing, right? And they don't take any of those gains. They don't do the gardening, that we talk about here, of trimming things back to what you had agreed was the rational portfolio allocation. And the problem is what happens is if there is a correction and there, you all of a sudden see these gains that were yours for the taking evaporate, and then you're basically the chance may have come and gone, right? Where a good investor always makes sure that if it exceeds what you thought was the rational allocation, that you take some of those gains off the table and actually realize them. All right, well, look, gentlemen, thanks so much. Folks, if you have enjoyed this interview with Lacy Hunt, would like to see Lacy come back on the channel again in the near future, please let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. If you would like help in navigating this increasingly interesting yet tricky time in the markets for investors, maybe you want some help implementing some of the strategies that John and Mike had mentioned here, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just go fill out the short form at thoughtfulmoney.com, and one of the appropriate financial advisor will reach out swiftly to schedule one of these consultations. As a reminder, they're completely free. There's no commitment to work with these guys. It's just a free public service that they offer. And as you may remember, Lacy talked with Lacy that he is going to be the keynote presentation for Thoughtful Money's upcoming fall online conference on Saturday, October 19th. It's going to be a phenomenal conference. And let me just address a couple quick questions I've been getting asked about it. One, the question I get the most, which is, hey, if I'm not going to be available to actually watch the conference live on October 19th, will there be a replay of the event? And the answer is absolutely yes. We pride ourselves on these events on getting the replay videos of all the presentations, of all the live Q&A from the day, including the transcript of the live chat and really everything about the whole conference. We pride ourselves in getting that to everybody within 24 hours or less. We usually get it out the same night of the conference. So you'll have the replay videos to watch to your heart's content very swiftly after the event ends. And then folks have just been asking again who's participating in it. So we have Lacy Hunt, who will be giving the keynote, as I mentioned. Lacy puts together a bespoke chart presentation for these conferences. And if you've been to one of the conferences in the past, you'll know what I'm saying. But really, like as soon as Lacy's section's done, which kicks off the conference, there's a ton of comments in the live chat of like, well, hey, look, that was worth the entire cost of admission right there. And that's just the start of the day. After Lacy, we'll have Stephanie Pomboy. She'll be giving her macro outlook on the overall macro situation. We'll have Darius Dale, who will be telling us what the latest that his model is saying about what regime we're into or we're entering and which investments he sees as appropriate for that. We'll have Michael Pinto, who will also be sharing his proprietary model and what it's saying. If you remember, his model has 5 different stages. So he'll be telling us where we are at that point in time and how he is allocating his portfolio accordingly. We'll also have Thomas Honig. He'll be back on again at that point in time. He's going to be talking about his expected outlook for both monetary and fiscal policy. And to make that a particularly interesting conversation, I've asked former Fed advisor Danielle DiMartino Booth to be the one interviewing him, and she's graciously accepted. So that's going to be fantastic. We'll have Michael Leibowitz come on. He'll be giving us an update on the bond market and what he sees ahead for that. He'll be followed by Stephen Bavaria of the Income Factory fame. So he'll be giving us specific tickers, specific recommendations of companies that are burning brightly on his radar for building an income-generating portfolio. Then we're going to have Dollar Milkshake creator, Dollar Milkshake Theory creator, Brent Johnson, giving us his outlook for the US dollar. He'll be followed by Lynn Alden, who'll be giving her advice on how to best protect against the decline in purchasing power of the US dollar and other major world fiat currencies. So she'll be talking about Bitcoin, she'll be talking about precious metals, and several other assets. They'll be followed by Melody Wright, who will be giving her latest update on the housing market. And then wrapping things up will be Rick Rule, who will be giving us his latest outlook on the resource investing space. But as you know, Rick, he brings it all to the table. He usually brings somewhere between like 30 and 40 tickers of the companies that are on his watch list or invest list, and he liberally shares those. So you definitely walk away with a lot of different companies to go explore. We will also be joined throughout the day by Thoughtful Money's endorsed financial advisors, so John and Mike, as well as Lance Roberts from RIA and Jonathan Wellham from Rocklink partners up in Canada. So you'll be able to ask them any questions you like throughout the day, but we'll end the day with a live Q&A, Ask Anything Q&A, where we'll basically take an hour and you guys can ask whatever questions you want of these financial advisors. I also just talked to Jeff Clark yesterday, and he has agreed to do a bonus video, which he has done for past conferences, giving his latest stock picks in the precious metals mining sector. So you will get that as a bonus for registering for the conference. So anyways, if any and all of this sound interesting to you and you want to attend the conference, or at least just learn more about it, go to thoughtfulmoney.com/conference. You can register there. And just a reminder, we are still offering the lowest early bird discount price. That's the price, the lowest price we're going to offer leading up to the conference here. I want as many people as possible to get that lowest price. So go register now. And if you are a subscriber, a premium subscriber to Thoughtful Money Substack, you'll get an additional $50 off the cost of the conference. And just a reminder, it only costs $15 a month to become a subscriber to the Substack. So if you want to pay $15 to save the $50, pocket the $35, I'm super happy with that. Game the system, go nuts. All right, John and Mike, gentlemen, thanks so much for hanging with me for yet another week. Thanks again in advance for being my partners in crime throughout the full day of the conference coming up in October. And look, it's going to be interesting to see what happens tonight after NVIDIA reports. I'm sure there's going to be some ripple effects through the markets afterwards, positive or negative. Look forward to talking to you guys on those next week. Everybody else, thanks so much for watching.
Thank you, Adam, and we'll look forward to talking about all of that soon next week.
All right, Adam, thanks again. See you soon.